Health insurers are becoming chronically uninvestable, and this is also something Wall Street believes is far from over. And if we actually look at the numbers year to date, the S&P for the large part has been fairly green. The areas that we are seeing quite a consistent flow of red happens to be the healthcare sector. Now, we also want to raise a case that August and September, being some of the worst months in the year historically for the S&P, could highlight they may continue that downward trend. And actually, when we zoom back to the last year, you're looking at not just some companies up double digit, but we also have some that are up triple digit, notably Broadcom up 101%, and still the healthcare sector has been lagging by quite some distance. Not only are we seeing red, we're seeing quite consistent negative double digit. UNH, in fact, down more than 50%. They've lost more than a half of their market cap, and that is the same that we can see with others in the industry. And what makes it even more fascinating is that we're actually seeing retail with record amounts of buying in the market, and it doesn't look to be slowing down. One thing that they aren't doing, though, is buying healthcare. We're seeing valuations being stretched across a wide range of industries, and in fact, when we also incorporate growth into the metrics, many sectors looking wildly overvalued, but healthcare for the large part is giving rise to opportunities. Now, we have to flag overvaluation across many sectors. For example, if we look at the tech space, Microsoft in isolation 34 is a fairly high forward P. That is also above their 5-year average of 32. And in fact, when we look at the blue tunnel methodology, which highlights the intrinsic price, we can see it is sitting just above the upper end, another overvaluation signal. The same for companies in the semiconductor space. Yes, Broadcom up phenomenal performance, but right now their forward valuation of 40 significantly above their 5-year of 18. And we can also see the blue tunnel really highlight the disparity between where the company sits today and the upper end of the intrinsic value. Like Microsoft, this is another one that is trading widely above its own fair price. And yes, even the great Costco, whilst the average valuation sits at 39, which to be fair does look wildly overvalued in its own right, currently it's sitting much higher at just under 50. And yes, the blue tunnel also reaffirming that severe overvaluation. So it isn't just what we're seeing in the tech sector, the semiconductor space, as well as a few others, but also Costco, and if we were to do a similar analysis on Walmart, would show similar signs. But you can look at this and say it is justified why we're seeing companies like UNH on a massive drawdown. The same thing keeps cropping up. Medical costs are becoming quite a significant issue. Centene Corporation, again, what do they say? Not only reporting a loss, but citing rising medical costs. Elevance as well, not only higher costs, but they're also cutting their outlook. And we can see Molina Health lowering their guidance not once, but twice in the same month. And that also expands to some pharma companies. It isn't just healthcare insurers. Merck Co laying off workers, narrowing their guidance, as well as seeing an earnings fall. We have Novo Nordisk cutting their guidance, which sent their stock down 30%. One that's similar to UNH hasn't caught a break in the shorter term. And it looks like Donald Trump's favorite words, tariffs, is going to have some effect on medicines, drug makers, where they stand to cost them billions of dollars, and that is something we're already seeing with investor sentiment. Some of these stocks are becoming a little bit scary to hold, but a famous investor said to buy when there is fear in the markets. This is something we're seeing, maybe not across the S&P, but at least narrowly focused on healthcare. UNH forward P below 15. We can see their 5-year average 20, a lot higher. This is what we would call, unlike Microsoft, Broadcom, Costco, severe undervaluation. Couple that with the yield above 3.7%, significantly higher than the 5-year average of 1.4, Again, undervaluation should be ringing in your ears. And we can also highlight that the blue tunnel is also showing us the exact same conclusion, although we have to be completely honest, something we don't like is that the blue tunnel, remember the expected fair value, has been decreasing in the last year. You really want to see the opposite. You want to see it go up in the right direction. But remember, there are reasons, as we've just seen some small snippets in the news. And it isn't just UNH, while they may take center frame. ELV 8.6 forward PE, well below 5-year of 14. Yield much higher than historics, 2.5 versus 1.2. Again, we want to be consistent and show the blue tunnel methodology, disparity only increasing in the last few months. This does mean potential opportunity, although whilst we'll get to our own valuation shortly, we should never look at these models in pure isolation. Again, Pfizer 8.2 below historical 11.1, yield 7.3 above 4.22 on the 5-year, a very consistent pattern for many companies right across healthcare, and Pfizer also showing us on the blue tunnel, whilst they have been severely undervalued for a large portion of time, right now that conclusion still holds true. And you might be tired of hearing this, but it is the same thing across many. We just want to back up what we say with the evidence. Merck Co 8.6, 5-year sitting at 13.2, yield now above 4%, historically at the 3 mark, and you can see the disparity, something that's pretty much been growing from November last year, really highlighting that this industry is showing signs that the market would rather chase high valuation companies. Yes, they are growing a lot better. In fact, some of these may not be growing in the shorter term, but they would rather ramp up the prices, ramp up the valuations of companies that we would say have entered overvaluation territory in quite some time. Humana also showing us undervaluation, 16 forward P versus 18.5, yield also higher than the historicals. And the blue tunnel, whilst it is confirming undervaluation, this one, unlike the previous, actually starting to creep into a reasonable signal. So we do also have to bear in mind, not every single company in this industry is undervalued. And of course, Novo Nordisk, like UNH, stealing a lot of the limelight given how much they've fallen. Forward P 12 versus 30, yield above 3%, 3.4 versus the 5-year at 1.41. And again, we can see such a massive disparity. However, one thing you may notice with this company, unlike the previous, we're seeing the share price decrease in the last year, and the intrinsic value has actually been moving in the upwards direction. Could be a good opportunity to consider if you do truly believe in the company. And now, very quickly, looking at each one of those that we run through, also seeing what institutions have done and giving you our own valuation perspective based on the DCF model and a few others. Looking at UNH, I mean, it was already down on Friday around 5%, just highlighting the downward trend. Negative 58% in the last year. Year to date, 53. So actually in 2025 alone, they've lost 1/2 of their market cap. And over the last 10 years, they've now entered territory where they've underperformed the S&P if you added 10 years ago, whilst trading pretty much at a 52-week low. Huge way away from 52-week high, $631, where both Wall Street and Seeking Alpha believe this company is a buy. Now, if we were to look at what the institutions are doing with their 88% ownership, yes, selling $38 billion, buying a lot more in the last year at $55 billion. However, they have now become net sellers in the most recent quarter, $2.8 billion selling versus $1.3 billion buying. Useful information if you want to incorporate it into your strategy, but clear to see, whilst they've been long-term net buyers, they have recently in this quarter turned sellers. In our intrinsic value, which we'll get onto for UnitedHealth, comes to $291, which is the average of the 4 models that you see on screen. Now, when we do deeper dives, which we actually do quite a lot for UNH, it is one of the most requested companies. We talk about the inputs and outputs for each model. Today, though, going through each one, we'll do high level. 291, also worth flagging, the DCF model for those that are interested, currently has a negative 5% growth baked into the numbers, meaning if you actually believe at a bare minimum their growth will be 0%, it will be flat, then it is looking like it could be undervalued. Now, we'll talk about this model shortly, but using all 4 at $291, we're not done because we want to apply an MOS, 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that, a buy at $262, then we keep going till it's near the current trading price, and ultimately we're saying around the $233 mark. This is giving you a 20% margin of safety. Now, Wall Street themselves see this at $340 into next year. That is upside of 43%, but we do have to bring it to your attention that over the last few weeks, they do continue to lower their target. So try not to use this too much as a base for your own investment, but just something we do incorporate when running through our own. And for consistency, we will highlight that at a 25% level, a buy at 218. So UNH, if you're someone that's incorporating all 4 models, then a 20% MOS. The reason why we have a secondary model here for the company is because a lot of this information is using the basis that the reasons for the drop is something that is going to stay with the company for the longer term. If you believe these rising costs is an isolated event, then you could look at the DCF plus the dividend discount model, which comes to $443 today. Now, using that basis, you will ultimately get a larger margin of safety, and as we keep going till it's near the current trading price, what we can effectively see is you're getting around 45% up to $244. So if you see this as a longer term issue for the company, we're talking 20%. If you believe actually isolated to just the year, maybe 2 years, 45%, and Wall Street $340, 43% upside into the next year. As always, let us know your thoughts, whether you see it as a buy, hold, or avoid. Now, before we move on to the next stock, just to let you know, we have released our latest free weekly article. We draw one every single Monday morning to your inbox completely for free, covering severely undervalued stocks as well as what's gone in the market over the last few days. So click below, you can sign up and read straight away, where you'll also be able to grab a recently released copy of severely undervalued stocks for the month of August. Lots of information for each one, the upside that Wall Street themselves see over the next year, and on top of that, you can grab a recently released copy of stocks that Wall Street themselves believe have the most upside in the S&P right now. So click below, you can sign up and read straight away. The next stock we're moving on to is Elevance Health, down 48% in the last year. Year to date, down 26%, so that's a quarter of their market cap wiped out. Over the last 10 years, like UNH, now underperforming the S&P, trading at their 52-week low, yet we get 2 healthy buy ratings from Seeking Alpha and Wall Street, 4.33, 4.28 out of 5, and we notice institutions with 90% ownership selling $10 billion in the last year, buying 50% more, unlike UNH, have actually continued to be net buyers. In Q2, $520 million buying, $442 million selling. If you wanted to note the reversal of this trend, well, you'd have to keep going back to Q1 2023. Now, our intrinsic value gets to $415, which, as always, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it's for ELV or any others. Whilst we're not going to go through each model, as we said earlier, what we will try and keep consistent, showing the growth rate baked into the DCF, and we can highlight for ELV, it comes to 2.8%. Now, in terms of a margin of safety, 10% a buy at 374, at 20% a buy at 332, at 30% 290, and actually we're saying near 35% at the 270 mark. Wall Street themselves, as we highlighted, fairly bullish earlier, 370 into next year, 35% upside. Similar to UNH, let us know your view as a buy, hold, or avoid. We then move on to Pfizer, down 24% in the last year, down 12% year to date. Over the last 10 years, actually pretty terrible. If in fact you've been holding this for 10 years, not reinvesting those dividends, you would be holding on to less than what you invested 10 years ago, trading near their 52-week low with a double buy from Seeking Alpha and Wall Street. Will actually highlight, unlike ELV, these are fairly low. 3.5 is what is needed to flip this into a buy, so we would call that a weak rating. Institutions, 68% ownership, selling 12 billion, buying 14, a little bit more buying than selling, but that's also consistent in Q2 where they have been net buyers. Just need to go back though to the previous quarter where we see the opposite and they were selling more. Now intrinsic value $30 given the current price will give you again another nice MOS, although bear in mind this industry does have a lot of issues, so you may want a bit more than usual. At 20%, a buy at $23.70, at 25%, $22.21. So 20% MOS for Pfizer, pretty much the highest yield on offer today as well, $29 into next year, 23% upside. Is it one for you or maybe not? Let us know. And then we move on to Merck Co, down 30% in the last year, down 20 year to date. Over the last 10, positive, unlike Pfizer, up 37, trading near their 52-week low. Double buy from Seeking Alpha in Wall Street, 76% institutional ownership, quite a lot of selling at 17 billion, but nearly twice as much at 29, and we see more buying than selling, similar to ELV. Unlike UNH, this is one institutions have been net buyers, and if we do in fact keep on going until we get to see the reverse of the trend, Q3 2023. Now intrinsic value at $108, and remember, using a DCF, we like to be consistent and flag, is negative 3.5% into the growth. So there are a lot of these companies in the sector, because the price has fallen so much, when we look at the DCF model, actually factored in is negative growth. Perhaps something you believe these companies are justified, or maybe you see this as a little bit ridiculous. Now, margin of safety will be fairly substantial again for this company. We're talking 30% at $76. 25% though is pretty much around that level of today's price, $81. Wall Street, 32% upside into next year, $104 is where they see it. Let us know, Merck Co, buy, hold, or avoid. We then move on to Centene Corporation, down 67% in the last year. That is insane when you look at that. Year to date, down 57%, more than a half of their market cap just wiped out. And over the last 10 years, they fall into that club with Pfizer, not one you really want to be in, where over the last 10 you would have lost money if you had invested, and they're also trading near their 52-week low with just one buy rating, although fairly strong at 4.18 from Seeking Alpha, and institutions with their 94% ownership selling 6.4 billion, actually more than they bought at 5.9, have continued that negative trend, net sellers in Q2 as well. However, in Q1 it was the opposite. They were net buyers. Now, Centene Corporation, we have looked at this in detail not long ago, where our DCF is $73. Now, bear in mind, there are a lot of things that we have factored to get to this figure. Ultimately, 2025's position, we have used what their free cash flow was for Q1, extrapolated it by timesing it by 4 for the year, then dividing it by 2 to be ultimately very conservative. And we've also used a growth rate of negative 4%. As you can see, these growth rates are subjective, -4, -2, 0, and that is why you can grab a copy, run your own numbers through, whether it's for CNC or any others. But what might be most shocking out of all of this is that on a reverse DCF, -25% is factored in to the share price today. Now, upside, depending on which one you look at, is very significant, but ultimately comes down to what type of margin of safety you want. In fact, if we go straight into it, you're getting 50% up to $37, 60% up to $29, and 70% around $22. So clearly not there yet. We're talking around a 60 to 60% MOS. Wall Street, as we've highlighted, like UNH, they have continued to lower their price target, and whilst we have included it, just bear that in mind, $45 into next year, 73% upside. CNC on the watch list, or maybe not. We then move on to Molina Healthcare. These stocks are really grim. We're talking such massive drops, -55% in the last year. Year to date, down 47%. Over the last 10 years, though, one of the better performing in the longer term, still underperforming the S&P, up 105. Trading pretty much at a 52-week low with just one buy rating from Wall Street. Now, institutions hold 99% ownership, selling $3.1 billion. So again, net sellers in the most recent year, only $2.5 billion buying, but that's changed in Q2 where they've become net buyers, and that's also something we see in Q1. So actually, 2025 so far, we do notice institutions net buyers on MOH, and our intrinsic value at $197 highlights that based on the DCF, reverse negative 1.7% is baked in. We've used 2% to be very conservative. You can see the upsides, no matter which one you use, looking fairly attractive. And in terms of a margin of safety, as of today's date, you're getting 20% around 158, 25 around 148. So 20% MOS for Molina Healthcare, 225 Wall Street expectations, 45% into next year. Let us know, but remember, whilst Wall Street do have these price targets, yes, we've said they continue to revise them, but remember at the beginning of the episode, when we opened, they do see this, at least at this point in time, as being chronically uninvestable in. We then move on to Humana, down 31% in the last year. Year to date, down 3%. Over the last 10 years, they're up 34%, so again, very poor, trading near their 52-week low. Just one buy rating from Wall Street, but very weak at 3.58, and institutional ownership at 92%, selling $5.5 billion, does show their net buyers in the last year, $8.5 billion buying, also consistent in Q2, and the reverse of the trend shows its face in Q4 2023. Now, intrinsic value $254. Again, DCF highlighting right now, baked into the numbers, is 0% growth if you do just want to use that model. But when we use them all together, you're not getting a 10% MOS just yet. It's not even at 5%. We would say this company is trading near its fair value. And Wall Street, we can see they had a hold rating. They see 288 into next year, 16% upside. We then move on to Novo Nordisk, down 64% in the last year. Year to date, down 44%. Over the last 10 years, they've now also underperformed the S&P, up 67%. Actually interesting just to step back and look at all of the companies we've reviewed so far. Not even one now, after all these humongous drops, have outperformed the S&P. And similar, they're also trading pretty much at 52-week lows. Just look at their 52-week high, $140. Feels like we were probably in medieval times when that price was around. And if we look at the buy ratings, it's only one now from Seek Alpha, although looking fairly decent at 4.16 out of 5. The other two, though, have it down as in fact a hold. Now, the ownership by institutions of 12% highlights, yes, 6 billion selling, a little bit more buys at 7 billion, but actually we see them net buyers in Q2, not something we noticed in Q1. Perhaps with this share price drop, we will see in Q3 a lot more buying. Will we see them by this massive dip? And our intrinsic value at $53, as we highlighted in yesterday's episode, is using a growth rate of 14%, but the reason why these prices, whilst keeping the growth rate consistent, have dropped massively is they ultimately revised their guidance for 2025, something that you can see we've also implemented in our DCF. So if actually you believe these growth rates still hold true, 10% upside at 14%. If you believe no, it should be lower, well, 12%, showing us pretty much it is overvalued. Also, whilst we will use a middle rate of 14% for an MOS, you can see baked into the numbers currently 12.6. Now, if you want to see these numbers based on the previous guidance, obviously they will be higher, then do check out one of our latest deeper dives on NVO, but currently you're getting around a 10% MOS. Wall Street themselves, again, we have to reiterate this, they continue to lower their price targets. At the moment, $73, 52% upside. And similar, to keep it consistent throughout the episode, 20% about 42 at 25, 39.50. So let us know on all of the companies we've gone through today, including NVO with a 10% MOS, 52% projected upside, if you have been buying what looks to be one of the largest crashes in the healthcare industry in quite some time, or you're completely avoiding. Don't forget, as always, to sign up to the free weekly newsletter, grab those spreadsheets, come and join us at Patreon, where we cover our buys and sells, and as always, have a great day. We'll see you all on the next one.